Hey guys, it's That Dividend Guy coming at you with another Robinhood portfolio update. Happy Wednesday. Hopefully everybody's having a GGD, a great green day in the market. You know, I always wish the best for my viewers and subscribers. So for today, we're going to be looking at the overall portfolio performance, the buying power, the individual holdings, and then my watch list and a couple of the changes that I've made. So for today, we're above $30,800, which is phenomenal. We're up almost $400 today. For the week, we're up $1,200, up 4.18%. For the month, we're up $2,300, almost $2,400, up 8.4%. The 3 month mark, we're up $2,700, up almost 10% for the past 3 months. For the year, we're up $6,000, up 24%, 24.5% for the past year. And then since April 13th, 2018, so 2018, 2019, 2020, 2021, so nearly my 3 year anniversary here coming up real quick in about a month. We're up $6,500, up 27.24%, and that's even with the big dip that we had in March of 2020, and again we had a little bit of a dip in October. So even with all the volatility, we're still up. That's dividends being reinvested and me finally being able to allocate some capital to the portfolio. Sad part is, guys, for about a year, I was out of a job, and then I got in a car accident for like 4 months last year. So last year. So I haven't been able to allocate capital the entirety of this time. So the fact that I'm still up more than double digits, is pretty phenomenal. So I'm excited. So buying power, we have 34.71. That's from dividends and me switching out FRT for WP Carey because WP Carey is cheaper, about $35 per share cheaper, and it pays a 2-cent dividend, like less than FRT. So I like WP Carey. Next, let's jump into the individual holdings, starting with Realty Income. We have 20 shares, $1,200 of market value. Average cost is $48.45. 4% of the portfolio is in Realty Income. Up $15 today, up $260 total, up 27%, and a dividend coming in on the 15th of $4.69. Then we have Allstate. 6 shares, $678 of market value. Average cost is $105.88. 2.21% of the portfolio is in Allstate. We're up $9 and about 20 cents today. Total, we're up $43.42, and a dividend coming in at $4.86. I want to see what they say the dividend is for Allstate. Good, it's 81 cents. They did boost it from 54 to 81 cents, which is phenomenal. Then we have WP Carey, my REIT for this set of months. We have 16 shares, a little more than $1,000 of market value. Average cost is $70.02. So we're down on this position. 3.55% of the portfolio is in WP Carey, up $11 today, down 27 total. Love WP Carey. Then we have my favorite stock for this set of months being Coca Cola. We got 21 shares, $1,000 of market value. Average cost is $51.39. 3.5% of the portfolio is in Coca Cola, up $5 today, down $5 total. Then MO, the big payer for this set of months, WP Carey will be catching it, but it will be a while before it matches the amount that Altria pays me. 152 shares, $7,300 of market value. Average cost is $43.59. 23.7% of the portfolio is in MO. That's going down because we're buying more of everything else. This is a really big position. I like MO, but I do want other companies to start, catching up to it as it comes to the overall dividends coming in. I don't want to be too exposed or more importantly, dependent on one company for my passive income. So I completely understand that right now I am over dependent on Altria, on AT&T, Abbvie, and Exxon Mobil, because those were the stocks that for like the past year have been down the most. So those are the ones that I've always bought. But now there are other options in the portfolio that I'm focused on. Then we have AT&T sitting pretty at $30 a share, 126 shares, $3,700 of market value. Average cost is $29.68. 12% of the portfolio is in AT&T, up $44 today, up about $40 total. Then we have 3M. They own 7-Eleven, and Mr. Car Wash, Mr. Hotshine Car Wash. So that's where I used to work. I got paid like $9.50 there, so it's funny because they actually pay me more in dividends than I got paid an hour there already. So this will be one that I'm adding to because I think it's pretty cool to own a company, to have a company pay me real estate wise that I don't work for anymore. 20 shares, $866 of market value. Average cost is $40.12. About 2.8% of the portfolio is in 3N. That will be going up $12 today, up $63 total. Oh, sorry. Then we have Abbvie, my big payer for this set of months. We have 60 shares, $6,400 of market value. $72.22 is our average cost. 21% of the portfolio is in Abbvie. That's gone way down. 73% of the portfolio we're up $70 today, up $2,100 total, up almost 50% on our Abbvie shares. Then we have my favorite insurance company in Aflac. Oh, it dipped big today. What the heck? Yeah, it looks like it dipped big, and it kind of did, but it's still above my average cost. 48 shares, $2,400 market value. Average cost is $46.28. About 8% of the portfolio is in Aflac. Up $19 today, up $208 total. Love Aflac stock. Next is Black Hills, 2 shares, $130 of market value. Average cost is $60.53. 0.42% of the portfolio is in Black Hills. Up $3 today, up $9.50 total, up 8%. Then we have McDonald's, my real estate position for this set of months. We have 2 shares, $423 of market value. Average cost is $214.90, so great price right now for me. 1.4% of the portfolio is in McDonald's, up $6 today, down $6 total, and a dividend coming in of $2.58 on March 15th. Then we have Exxon Mobil, the big payer for this set of months. That's been skyrocketing as of late, way past my average cost now. 86 shares, $5,200 of market value. Average cost is $52.74. 17% of the portfolio is in Exxon Mobil. $126. We are up today, up 2.44%. Total, we are up about $740, up 16% on Exxon Mobil, and a nice juicy dividend coming in here in a couple of days, I believe, but at least by Friday we'll have the dividend, and we'll have over $100 in buying power. A dividend coming in of $74.82. So, love ExxonMobil. It's one of those that everybody asks why I wasn't selling it at like $30 and my average cost was at $52. Well, now oil's been going up like a rocket, and it's way past my average cost, nearly $10 up per share on 86 shares. So happy I held ExxonMobil. I know oil got a little volatile, a little scary there for a while, but if you're a long-term investor, you really don't care. When oil went negative, if I had the capital, I would have bought a bunch of ExxonMobil. It got down to like $30 a share, which is just a nasty price for them. It's so, yeah, like $32 a share. That's insanely low. That's like half my average cost. So yeah, definitely a great time to buy oil at that point. But now, it's gone way up. So happy that I have my shares of Exxon. Happy that the dividend's so nice. But I will, like I said, the goal is to be less dependent on these stocks for my income. So I want to make sure I buy more and I have more options in the portfolio. So with that being said, we should have over $100 in buying power with a 34 plus to 74. So I'll have like $108 by Friday for passive income. Might transfer some cash over just so I can buy some more of more stocks for the first set of months, being either WP Carey, Allstate, or Coca Cola. Maybe even buy a couple shares of O because I love it so much. But for the watch list, I switched out Kimberly-Clark for Pepsico. Nothing wrong with Kimberly-Clark. I just love Pepsico. If it would pop up. Right, there we go. So Pepsico at 133, definitely buying it there. $18 or $15 of upside, which is my minimum. They own Mountain Dew, Sobe, Gatorade, of course Pepsi, and a bunch of other brands. And then of course Doritos, Cheetos, they own Frito-Lay. So I want PepsiCo. It's going to be my food stock for the portfolio. I know it's a beverage, but they own Quaker Oats too. Excuse me. So they're going to be my main focus for food stocks, and they pay the same month as Coca Cola, but they don't pay. They pay 1 for $7.10 like they're supposed to. Coca Cola pays 4 $7.10 10, 12. So PepsiCo is going to be my food stock for the portfolio. I don't think it will be as big as Coca Cola. Maybe we'll see. Coca Cola is my favorite stock, but PepsiCo is actually more diversified, and I like Coca Cola as a drink more than I like Pepsi. But as a business, I actually like Pepsi more than I like Coca Cola due to Doritos and Gatorade. So next, we have Marsh and McLennan. This is my insurance stock for the set of months, being 5, 8, 11. At 117, not low enough for me to be purchasing it right now. Then we have Procter and Gamble. They have a bunch of consumer brands. Gillette, I believe they own Pampers. They own so much it's hard to even go through it all. But $127 a share. Definitely buying it there. Then Travelers. So I switched out Public Storage, and I might switch back and forth. I like Public Storage a lot, but Travelers is focused on insurance, the sixth largest company in the U.S. when it comes to insurance companies, and the second biggest underwriter of insurance. So I like Travelers. I've looked at them before, and I will own them eventually. I know Aflac is a really big position for me currently, but eventually I do want Travelers to be added to the portfolio as well. And I do feel more comfortable with the insurance business. They are dividend growers instead of Public Stores that has not grown its dividend for a while. Travelers is, I believe, at 10 or 11 years of dividend growth, maybe even more than that. I think it could be 10 to 15 years. Dividend Diplomats just did a video on them, and their payout ratio is at 30%. So they are just as good as Aflac when it comes to their payout ratio. And they are not as good at the dividend growth as Aflac is. That's why I picked them before I put money into Travelers. But I do like Travelers stock. So at 155, only $2 of upside, not buying it here. But next we have Berkshire at 265. They are up big today. But 52-week high is at 66, so definitely not buying it there. But when it comes to insurance, they are the king of insurance, and that's really what I'm focused on this year. I want to focus on not being so dependent on certain stocks for my income, and that means buying other companies like Aflac, like Travelers, like Procter and Gamble, like Coca Cola, and WP Carey. There's nothing wrong with the big positions that I have. There's a reason that they're big positions. They're great companies. But I don't want to be overexposed to certain companies in case something goes wrong or we have a dividend cut or something like that. I want to be focused in my portfolio and confident in the companies I own. I do believe that what Charlie Munger and Warren Buffett said, that diversification is protection against ignorance. So you should only be quote unquote diversified if you don't know what you're holding. The thing is, I do know a lot. I've done extensive research on every company that I own. I just want to make sure that I have options because, as you guys have noticed, a lot of times it's always the same companies that are down. That's why I have such a big position in the companies that I do, because a lot of times they're constantly down, which that's not a bad thing. It's just I want to have other options for when it comes to deals for certain months, because of course you guys know my strategy. I always buy the next month. Well, like for example, AT&T's above. Let's take a look real quick. Why I want to add a couple companies for my second set of months, because that's going to be because we're at 3. So let's take a look at the first set of months real quick. So Allstate's X date is past, so there's no point in buying them because if I buy them now, I won't get a boost for my passive income for next month. But the thing is, they're up, $12 a share, or sorry, $7 or $8 a share from where I bought them at. So, according to my strategy, I want them lower, so I can't buy Allstate. WP Carey is a stock I can buy because it's below my average cost. Coca Cola is at 51. I can buy Coca Cola as well. MO is at 48. So I cannot buy MO. So right now the only deals that I have currently are Coca Cola and WP Carey. So that's not bad, but I also want Pepsi because I want another option. So that's really what this is about, guys. I know the companies I own. I know the watch list changes kind of a lot, but that's the point. They're companies that I'm looking into that I want to own, that I might want to hold long term, and I'm doing research on them. There are certain ones that have come back and forth, like Pepsi. I know their product line, I know their specs and whatnot. I did the same thing for Kimberly Clark. Um, so some companies come back and forth, like Public Storage. I've done extensive research on them. I've owned them before. It's just I don't. Um, I want to make sure that I don't find something better. As in, like, FRT got switched out by WP Carey because I didn't know about them. They're industrial, and I have already some pretty big retail exposure with O. So having FRT is fine. It's a great company, but I don't want to have overexposure to retail, especially when I believe that Amazon's going to be destroying retail overall, in the coming years. I know industrials are going to be around. They're diversified, so I don't want to be in one too heavy, and not only in a sector as in REITs, but I don't want to be too heavy in a type of REIT as well, because if that one type of REIT gets destroyed, as in like Amazon comes for them, or maybe specs aren't as good for them, something like that, then I'm not overexposed and losing a lot of dividend income. So I want to be diversified, um, as in the companies in the sector as well. But I'm very confident where I'm holding companies. So, like I said, with Berkshire Hathaway, I do really believe that over diversification is simply used because people don't know what they're holding. They just buy. So, like, I see this on YouTube all the time. They'll buy like a REIT and they'll be like, "Oh, this is great." And then, like, when the economic collapse happened, or like the pandemic happened, a lot of these companies that people were just buying because there was YouTube hype behind it, or some stock picker on YouTube said it was a good stock, they got slammed. The stock went down, the dividend got cut. I'm picking quality companies because I know people might try to emulate my portfolio. I don't recommend that. I can't tell you what to do with your money. I'm not a financial advisor. You need to invest at your own risk. But say somebody were to buy Realty Income, I feel a lot better about them buying Realty Income than like ARR or ABR or some REIT that cut their dividends, or NRZ, one that has a high yield that's probably going to get cut the next time that there's a big correction in the stock market. So I realize the power that I have here on YouTube, and I don't want to damage people's financial futures by throwing a Hail Mary at a stock that has an 8% yield that's going to get cut the second the stock market drops. So with that being said, guys, thank you so much for watching. Remember to hit the subscribe button. We're really close to 510 subscribers. I plan on posting every single day again. I just took some time off just to get a breather. We had some family stuff come up, so I wanted to make sure that I had enough time to kind of recover from the events that happened. So thank you so much for watching, guys, and I'll see you tomorrow with another Robinhood portfolio update. Take care.